Maybe. I woke up this morning, logged into my StockTwits watch list to be blown away by the 3 to 5% mood swings to the downside in large tech, only to be rewarded at the end of the day with almost a full recovery in companies as volatile as Tesla, for crying out loud. And all of this is being driven by that hyperinflation story. So what I want to talk about today is further expand on how this trend is your friend and where you can park capital to protect yourself from further volatility, what I'm doing with my own money to just try and protect myself, and see how this unfolds over the coming month. Because what we're going to do here is just take a look at some data that the Federal Reserve and the Canadian Treasury look at and why this is going to lead to further volatility before we dive down into stocks that are still getting absolutely slaughtered, and again, companies that will probably do pretty well through that. If that's something that interests you, of course, always consider hitting that like button. As the market ever evolves, I will always be here offering my own personal opinion. They'll keep this as entertainment value because God knows what actually happens. I mean, it's almost a gamble at this point. But take a look at what the Federal Reserve and the Canadian Treasury look at. These are your consumer price indexes, taking into account, rent, food, things you use on a daily basis, and they are continuing up and to the right, almost in a hockey stick manner. This data only goes as far as November, and we know it's been getting worse coming into the beginning of this year. So what we want to pay attention to, particularly for the broader U.S. market, is watch the Federal Reserve meeting coming up on January 25th and 26th, according to this website. I've heard it was on the 26th, 27th, but I'm hoping one of these 2 days, which is going to be one of the craziest weeks I think we're going to experience in the market, because, guys, that is when big tech is going to be posting earnings for those Q4 numbers that are coming out of the 2021 holiday season, right? And considering Facebook had record downloads for Oculus, considering Apple's likely going to have record deals, it's going to make the market probably have some kind of an adverse to weird reaction to it, because there's no way this Fed meeting is going to be anything other than uncomfortable, considering Jerome Powell admitted that they have been under anticipating at the rate of inflation. So that means they're going to tamper faster, increase interest rates faster, and vacuum up all that money that they've thrown out into the markets, right? Or as Kevin O'Leary calls it, that helicopter money. But continuing on here, folks, I mean, take a look at the volatility in what no one's talking about, and that is commodity prices that are largely driving a lot of the hyperinflation, right? Like if lumber spikes like this for no reason. Look at the lumber prices in the last year and a bit. Oh my God, guys, lumber is what we're using to build homes, for Christ's sakes. And it looks like we're going back to extremely high prices. I mean, we're taking a look at uranium, a huge sector favorite here when people are buying uranium stocks. Looks like that's boding well into the beginning of the year. Oil is another big one for a lot of people. Crude oil has been going back to decent highs, obviously continually increasing the gas prices or keeping them at a base level that is probably on the inch of being uncomfortably high for most people. But then again, a lot of us are working from home, so who gives a shit about gas prices? I know I don't anymore. But let's talk about the markets here first, folks, because the NASDAQ this morning, I mean, took a wicked bump down, like 2.5% at the bottom here, to only recover and actually end up green on the day. Look at the green return here. Absolutely insane, guys. Like, you could have day traded this. Not that I day trade, but this is a day trader's market, dare I say. But look at the 5 days. The Federal Reserve released their minutes on being incorrect about hyperinflation, and that was almost a week ago. And the markets have been in a downtrend ever since, especially in those higher risk assets, which we can see in the NASDAQ. And I'm a little worried, guys, that this is just a beginning of a trend. I mean, I really feel like this sell-off could continue over the coming month, 2 months, or maybe even the next quarter. I don't know. Time will only truly tell. But what you can do is to kind of get away from those higher risk investments, because a lot of us want to be buying large tech. And arguably, if you're brand new to large tech or the S&P top 10 companies, perhaps nibble on these dips. I mean, there's nothing wrong with putting starter positions in. I personally, however, would have a hell of a hard time throwing big dollars at this, except for maybe in something like Facebook, but that's just a personal preference, right? Because the S&P is only down 2.6% at the lows, and also had not as much of a rebound in the last day, but it's still, guys, relatively flat, right? It didn't go into the green at close, but it did finish flat for the day. But take a look at the last month here, guys. It is selling off, but nowhere near to the extent of the NASDAQ. So what you can do, and what I would recommend personally, and what I kind of almost do now, is just put a little bit of money into these index funds. I mean, it's a great place to park capital long term. And hey, if stocks take a huge hindrance, guys, like a huge hindrance, like a 15, 20, 30% decline, there's no way this index is going to be down nearly as much. So what you can do is sell off a little bit of the index and then go back into some of these individual holdings, like your large caps that might be at a much more prevalent discount. So that's how you can protect yourself slightly from the downside if you're not into, say, getting put options on your favorite stocks, you're playing options in that direction. This is a really kind of simple way of refining that, because what I think is going to continue happening, guys, and what's going to hold up the index and kind of get rid of that volatility in large tech is going to be coming from these kind of consumer discretion financial sectors that perform very well in risk-off environments and in hyperinflated and interest-raising environments. So that's obviously your JP Morgans of the world, which in the last 5 days, I mean, is up almost 2%. The last month up 5.9%. And again, on the Canadian side of the border, they're almost continually the same. They're like rhyme with each other, because the Canadian banks have been doing just as well. Obviously, the Canadian Treasury is looking to raise interest this year as well. Pepsi, obviously, these are like your Ray Dalio stocks, guys. You could look at even the global market index funds and just park some capital there. This is where you're going to get more security, I think, in individual companies. You're not going to get the upside potential that you're going to get from tech by any means. I don't know how, we see Pepsi double here to 30 PE. It's very expensive, but I'm almost sure we'll get less volatility out of these guys. So let's talk about, the big tech here, guys. I mean, Apple in the last 5 days is down 5.77%. And look at the volatility in the single day here. I mean, this thing is moving a few percentage points, which doesn't sound like a lot, but when we're talking about a $3 trillion market cap at its peak, this is insanely volatile, right? So I would be a little bit careful with these kind of really extensively valued large tech companies. As I've said this in the past, if you buy these today and you think you're just going to make a quick return, guys, you better be in for a 3 to 5 year ride before any of the earnings catch up to the current valuations. This is why I am only bullish really on Facebook stock in the midterm. And that doesn't even guarantee that Facebook goes up, right? There's no guarantee paying fair value for a company means you get an instant return in a year. I don't know what happens here. I'm just very hesitant and very concerned because, again, when those interest rates go up, when hyperinflation gets out of control, these are the kind of companies, even though they're great companies, tend to do not the worst in comparison to what we're going to look at, but they're not going to be going up, which means you're going to be getting buying opportunities. So what you can do is pick up the dips and just be patient and be prepared to be buying more dips in the future. Or hey, at least maybe you nibbled a little bit, and if it does go up for God knows what reasons, you've got a position started. So let's talk about risk on investments, like heavy risk on, guys. This trend has yet to change coming into this new year, and it is only hitting investors harder. I'm sure you've seen all of your YouTuber stocks, your tattoo chefs of the world, your Hyliion stocks. I mean, take a look at Zuma, Kathy Wood stock, down almost 7% here, or 70%, 7% they wish, 70% here. And even though most countries, not most, but places like Canada, places like the US, there's a little bit more fear mongering going on with more lockdowns. So people are still using Zoom aggressively. And yet, oh my God, guys, like let's take a look at the last 5 days here, down 5.8%. The last day showing, again, same kind of volatility. Look at PayPal, for example, down a whopping 40%. Coinbase. This is one that I'm really intrigued to watch this year. Great fundamentals for a smaller cap growth. Well, it's not really small cap anymore. I mean, $50 billion, right? So it's a mid cap. But at the end of the day, guys, down 37% from those all-time highs. Like I mentioned, Hyliion here down almost 90%, just absolutely killing investors with no rebound into the close today. So anything that doesn't have positive EBITDA, underlying fundamentals that a real investor, a hedge fund investor can wrap their head around, because you talk to anybody that understands value metrics, they're going to tell you Apple, Microsoft are crazy ass expensive companies here. They need to drop 15, 20% before we're starting to get into that fair value range. So if that's how big companies managing those hundreds of billions of dollars in assets, those are the guys that are going to move these companies into the future, right? So you want to pay attention to where that big money flows. And right now, the only place it really seems to be flowing is into the banks, the Pepsi stocks, and a very few other considerations. So what you're going to want to do here, guys, is just take a breath. There's no rushing in this market. I am a long-term cost average investor. I just look at these cyclical microeconomic trends and I just start placing my new capital to invest, because I'm not somebody that's inclined to sell my tech stocks by any means. But if I see things like, the banks heading into a cyclical trend to the upside, yeah, I might buy them even though they're at all-time highs. If that's the way the market's going, I wouldn't mind cushioning some of the blow here. I wouldn't mind buying a little more index funds. I want to be a little more risk off in a risk on environment, right? Or a risk off environment, I should say, because ain't nobody putting risk on the table right now. They're pulling it off. And to be honest, guys, who the hell sells shares at the bottom of the market? Who honestly sells Hyliion down here? Who sells Coinbase or PayPal once it's dropped 40%? There's no way you can use tax loss harvesting as an excuse anymore. I mean, if Charlie Munger doubled down on friggin' Alibaba into the last quarter of the year and you're selling out of that to tax loss harvest, I'm sorry, but you've been taught something terribly wrong about the market if that's your excuse to sell down here. But anyways, take a look at the VIX, folks. The volatility index is what I'm going to be watching just to see if this trend continues to the upside. And like I said, sit tight, sit patient, because that Fed meeting is going to be a roller coaster of a ride. In light of this, folks, I'm going to pass that question off to you. How are you handling the start to the year? There's a funny meme that I found that says, you know, I've had my free trial, my 7-day free trial of 2022, and I'm not happy with it. I want my money back. Cancel that free trial because, oh my God, guys. Oh my God. So stay cool, stay awesome, and I look forward to catching you in the next one.